Hey everyone, welcome back to Financial Market Insights for Traders, the show where we cut through the noise and talk about what really moves the markets. I'm your host, Sophia, and today we're diving deep into advanced territory. This episode is for those of you who already understand the mechanics of calls and puts, and now you're hungry for more. You want the next level. You want power strategies that go beyond the basics. If that sounds like you, then buckle up because this masterclass is going to arm you with iron condors, straddles, calendar spreads, and more. Most of what you hear out there, even on decent finance podcasts, barely scrapes the surface. They cover covered calls and vertical spreads and stop there. But if you've been searching for options trading strategies advanced and feel like the content just isn't giving you what you need, you're in the right place. Let's get into it. Segment 1. Iron Condors, the non-directional income generator. The Iron Condor. It sounds like something out of an Avengers movie, but it's a staple in the pro trader's toolkit. What is it? It's a combo trade, a bear call spread stacked with a bull put spread. Here's the breakdown. You sell an out-of-the-money call. You buy a further OTM call to protect yourself. You sell an out-of-the-money put. You buy a further OTM put, again for protection. All four options share the same expiration date. The idea is simple. You're betting the stock will stay in a defined range. So when do you use it? Perfect in low volatility environments. Think of times when there's no major earnings on the horizon or macro catalysts that could cause a breakout. This is your go-to during market lulls where everything is consolidating. Why does it work? Because you collect premium from both spreads. As long as the price remains within your range, both spreads expire worthless. That's a win. The risk? If the price breaks out of your range to either side, you can lose. But here's the upside. Your loss is capped. You know exactly what your max exposure is when you enter the trade. Pro tip. Always play this when implied volatility is high. The volatility crush is your friend. That premium you collect? It deflates when the market settles, increasing your chance of profit. And use delta neutral positioning to reduce directional exposure. Segment 2. Straddles, your weapon for uncertainty. Next up, the straddle, a pure volatility play. You buy a call and a put at the same strike and expiration. It sounds simple because it is. This strategy is best when you expect a big move, but you don't know which direction it's coming from. Prime setups, earnings announcements, Fed meetings, CPI numbers, product launches, anything that can make a stock jump or tank big. Why it works: if the stock makes a sharp move up or down, you profit. The only thing that matters is that the move is larger than the total premium you paid. But there are risks: time decay and that dreaded four crush. If the move is smaller than expected, you lose money on both sides. And remember, you're paying double premium upfront. Pro tip: use straddles when volatility is underpriced, not overhyped. Look at historical earnings reactions and check 4th percentile to avoid overpaying. And if you want to get fancy, sell straddles in high for when you think the move will disappoint. But be ready to hedge fast. Segment 3. Strangles, straddles with a budget. Let's talk strangles. It's basically the straddle's cheaper cousin. You still buy a call and a put, but both are out of the money. This lowers your cost, but it also means the stock has to move more to hit profitability. Use this when you still expect a large move, but maybe your confidence isn't 100% or you want to manage your upfront exposure. It works well for small cap names or meme stocks that are prone to wild swings. Same risks apply: time decay and volatility crush. Just remember that since your strikes are OTM, the bar for profitability is higher. Pro tip: monitor open interest and look for unusual options activity. That's often a hint that institutions are prepping for a big move. Segment 4. Calendar spreads, arbitrage time, literally. Calendar spreads let you profit from differences in time decay. You sell a short-term option and buy a longer-term option at the same strike. It's a bet that short-term implied volatility will fall while longer-term expectations remain intact. These are great for post-event plays, like after earnings when short-term vol drops but long-term uncertainty remains. You make money as the front month option decays rapidly. The risk? If the stock moves too much too soon, you could lose. You need it to stay within a specific range for the best payoff. Pro tip: use these in sideways markets and around events that you expect to be non events. Also, consider rolling the short leg week to enhance profits. Segment 5: Ratio spreads, back spreads, asymmetric power plays. Ratio spreads and back spreads are about controlled aggression. Let's say you sell two puts and buy one ITM put. That's a 1/2 ratio spread. Or in a back spread, you buy more options than you sell. These trades give you huge upside if you get the move right, and manageable risk if you don't. Use them when you expect an explosive move in a specific direction. They're especially useful when you have high conviction in a breakout or crash. But watch out. These are directional trades. Get the move wrong or mistime it, and the losses can stack up fast. Pro tip: always use a payoff diagram before entering. Don't trade these blind. Segment 6: Tools, Macro, and Automation. Now, advanced strategies are only as good as your tools. If you're serious about this, invest in platforms that offer real-time Greeks, strategy builders, historical 4 overlays, and multi-leg order functionality. If you're looking for the best trading software for advanced traders, those features are non-negotiable. But what about macro? If you're into global macro investing, use these option strategies to express views on rates, currencies, commodities, and political risk. Imagine straddling the dollar index ahead of a Fed decision. That's tactical. And then there's automation. If you're curious about algorithmic trading for beginners, learn to code basic bots or use no-code tools that let you automate entries and exits. And if you want to go deeper, tune into the Crystal Ball Markets podcast. It's packed with insights on algorithmic trading, quantitative trading, and building systems that work. AI is also breaking down barriers. We're talking sentiment analysis, anomaly detection, volatility forecasting, all accessible to retail traders now. Segment 7: Digital options as a training ground. If this sounds overwhelming, start simple. Dip your toes in with digital options. Platforms like crystalballmarkets.com offer beginner-friendly tools to practice direction-based trading without getting crushed by time decay or gamma exposure. Digital options let you work on directional accuracy without all the complex Greeks. A great way to build confidence before you get into multi-leg trades. Wrap up: strategy plus discipline equals edge. All right, traders, here's the bottom line. These strategies, they're not just about looking smart. They're about structure, risk control, repeatability. You're not here to gamble. You're here to trade like a professional. Advanced trading strategies are your toolkit, but tools are only as good as the hands that use them. So whether you're a global macro trader, a system builder, or someone moving from retail guessing to institutional grade thinking, these concepts are your next step. And remember, strategy alone won't make you profitable. It's your discipline, research, and risk control that turn strategies into edge. Don't forget to check out the Crystal Ball Markets podcast for deep dives into quantitative trading and automation, and crystalballmarkets.com digital options platform to start testing your ideas today. That's it for today's episode of Financial Market Insights for Traders. I'm your host, Sophia. Trade smart, trade sharp. I'll catch you in the next one.